Good morning and welcome to the Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Nate Tuff, CIO and Senior Portfolio Manager at Manulife Investment Management, will be joining us for the hour. The Artemis 2 mission is set to launch this evening. Now we'll talk to the Canadian company working with NASA to make it happen. Mike Greenlee, CEO of MDA Space, will be here in 30 minutes. And of course, we want you to join us as well on First Call. Reach out with your sector questions, and we'll have Nate answer as many of them as he can at the end of the show. The number, 1-855-326-6266. We'll open the phone lines in about 30 minutes, and our email address is firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. Group Dynamite logged a higher profit in the fourth quarter, driven by increased in-store demand and strong online sales. A Quebec-based company also expanded its garage brand in the UK in early 2026. The retailer posted a strong outlook for revenue growth for the full year, but cautioned for multiple risks, including tariffs, a decrease in customers, and failing to open new planned stores. Shares of Tilray are higher in the pre-market. The cannabis company beat estimates for its full-year profit guidance. The Ontario-based company also saw third-quarter revenue grow for all segments except for alcoholic beverages. Tilray says its diversified platform well equips the company to navigate industry headwinds and leverage emerging opportunities. Oh, and look at Nike shares right now, off by more than 10% in the pre-market after the sportswear company gave a gloomy outlook for the year. Revenue is expected to fall 2 to 4% in the current quarter and continue to be in the low single digits for 2026. Nike is being affected by elevated inventories in Europe and the Middle East and traffic disruption from the war. Weakness in China and other markets also overshadowing strong results in North America. And now our top line story. U.S. President Donald Trump says he foresaw the U.S. ending the war on Iran within 2 to 3 weeks, suggesting the U.S. had largely accomplished its military goals. When speaking to the media on Monday night at the White House, Trump also said, Tuesday night, Trump also had more strong words on NATO, signaling in the Telegraph that he may pull the U.S. out of the alliance after it failed to join his war on Iran. For the latest market reaction, let's bring in our guest for the hour, Nate Tuff, CIO and Senior Portfolio Manager at Manulife Investment Management. Nate, thanks as always for joining us.
Great. Thanks for having me.
The market seemed very happy yesterday about what they heard from the president. Were they too happy? Was it a little bit of a little too early celebration, do you think?
I think this is a classic example where the market is hanging on every news announcement and trying to teeter into whether it's a good news story or a bad news story. And yesterday certainly was a more positive story, but at the end of the day, it doesn't really change the uncertainty that's still overhanging the dynamics of the market. We are going to continue to see days where the market interprets headline news as negative, and we're going to continue to see days where it interprets it as positive. So volatility is here today. I do think, as we have thought for a while, that we do get some type of de-escalation and resolution within Iran over the course of a shorter period versus a longer period. But at the same time, it doesn't seem to have a clear deadline or a clear timeline at this stage.
Do markets figure out geopolitical events like a war like this? Do they figure it out and kind of manage to work with it?
They absolutely do. If you look at history, and we have a lot of historical examples of geopolitical dynamics, typically the market bottoms only about 10 to 20% into the time frame. So markets generally start to rebound well before you get an outright conclusion or an end to these types of geopolitical risk. And we've seen it even in the worst case geopolitical risk. You go back to World War I, World War II. Typically, the market bottoms much earlier than the actual end of the situation. And that's because markets are very forward-looking, and they start to dismiss or they just get tired of the news story to some extent. That's not to dismiss the severity of the situation, but the reality is the markets tend to bottom much earlier in a negative geopolitical dynamic than they do waiting till the end of it or the full resolution of it.
And where do they normally bottom at? Is there kind of a figure that comes to mind, or is it all over the place?
That's the challenge. The magnitude can be quite wide. And in this particular example, I would argue the markets have held up very well. If you look at global markets, there's some examples where the corrections have been more meaningful. But generally speaking, the market has taken this in stride. And in reality, you could argue that they are underpricing the worst case scenarios quite significantly. That's because the market has been looking at this with a half glass full, that this will not be a prolonged, indefinite type of situation, and has traded in that manner since the beginning of the situation breaking out.
Now, if there is if the Americans tonight, when Trump speaks, says we're pulling back and we're going to launch a few more bombs and pull back, Iran's going to run the Strait, and oil is going to stay at $100 a barrel. What kind of an impact do those things have on the markets and how people interpret it?
Well, it's hard to get a decisive conclusion to this, right? Even if what you say comes to fruition, it's hard to determine how exactly the markets will react to that, because there's going to be new news that follows that in quick order, right? And so I think if you have oil stay at above $100 for a prolonged period of time, basically you're talking about a 0.5% of growth reduction across the developed world, a bit more than that for the developing world, and you're talking about a 1% higher inflation rate for much of the developed world. That doesn't sound like a lot, but that is meaningful in the terms of central bank policy and general consumer impressions of how it impacts lives from an inflationary perspective. So it is pretty significant when you keep oil above $100 when it comes to how the market and how policy reacts to it.
And how do you see policy reacting then if we do end up in that ballpark, which kind of feels like that could be something that could happen? Are cuts off the board then in the U.S. and here? I've heard now that we're talking we might see three rate hikes in Canada.
I think it's trickier than that. I mean, obviously, this is one lens that central banks are going to be looking at, including the Fed. But the reality is the membership of the Fed is evolving. And we do know there has been plenty of evidence that the Fed is willing to look through inflation if it's viewed as temporary or transitory in nature. And I think if the market reaction and or the economic reaction is more dire when it comes to growth dynamics and job dynamics, the Fed will prioritize that over inflation. So we actually believe the market is underpricing the potential for the Fed to cut at this stage. And we still believe the Fed will likely do 2 quarter points this year, followed by yet another one in 2027. So what we've done is pushed out the cuts, did I say hikes earlier, cuts further into the end of the year and into early next year versus what we had previously thought, which was starting as soon as basically this month.
Okay, we have to take a break right now, Nate, but thanks very much for joining us. As always, we'll have lots more with Nate coming up. But first, a look at the markets before the bell. Let's see how things are shaping up on the markets. We'll start with U.S. futures and the rally from yesterday carrying into today, at least right now. Who knows what will happen? Who knows what comments we'll hear today? What may change things? But for now, Dow is up 0.73, the NASDAQ by more than a point after jumping nearly 4 points yesterday. And the S&P 500 up by 0.78. Heading over to Asia now. And look at those numbers. All of them well into the green. The Nikkei up by 5.25, biggest single-day gain of the year. The Kospi in South Korea, we don't have it up there, but it jumped more than 8%. And you can see the Hang Seng up by 2. CSI 300 up by 1.7, all on the news from yesterday. Heading to Europe. And the rally that started yesterday also continuing again today with optimism there. You can see FTSE 100 up by more than, all of them up by more than 2. The DAX is up by nearly 3% right now. And the TSX yesterday, it had a very good day, up by 2.6%, and pretty much index-wide rally led by materials and tech. They were up 6 and 5% respectively. The energy index, the only one in the red, and that was by 0.01%. Some of the winners and losers yesterday. G Mining Ventures and Curaleaf, look, both of them up by 13.64%. And the ones that were down weren't down by much. Advantage Energy down by 3.6 and Methanex down by 4.7. Taking a look at metals now, and gold surging again, up nearly 2% right now, continuing to push towards 5,000. Goldman Sachs saying it could hit 5,400 by the end of the year. Silver also rallying, and copper still in that 550, 560 range. Taking a look at oil, Western Canadian Select. Yeah, the reaction to the news, of course, no surprise there. It was down by nearly 4%, down to $80, just almost dropped below it, but still just slightly above 80. And what is WTI doing today? And it's down again off 2.5% to 98 right now. It's trying to find its range. All right, with us this hour is Nate Tuff, CIO and Senior Portfolio Manager at Manulife Investment Management. And Nate, your POV is that AI is best understood now as a capital investment cycle, not speculative excess, despite what everybody's spending on AI right now.
That's true. We do believe that this is a big secular theme, that it will be in place for quite some time. And the amount of capital expenditure into the infrastructure that required is massive and hugely supportive of global economic growth activity. In fact, in some geographies, it's making up a decent chunk of economic growth activity. And we think that trend will continue. That does not mean everyone can win, however. And this is where I think we caveat by our more positive views on AI, is there will be winners and losers. And we are starting to see the market really delineate between those winners and losers, and expect that to continue to be the case looking forward.
Where are the early winners showing up right now?
Well, the early winners continue to be the folks that are building the infrastructure, the folks that are supplying the componentry, such as the semiconductors, such as the infrastructure that goes into the grid and electrical build out, et cetera. So those have been the winners. But more recently, what we're starting to see is signs showing up where the adopters are starting to begin to gain some ground. And the ecosystem of AI is actually broadening, not shrinking, as it relates to the broadness of the participation in this theme. And so the winners have been what we call the enablers, the folks building things. But we actually think the beneficiaries, the folks that are adopting it, will likely be the winners more so looking forward.
All right, and if we start seeing money move towards the adapters and it's paying off for them, what happens like to the Mag 7, and where do we see them heading?
Well, we've already seen the Mag 7 begin to disappoint. They haven't moved much over the last 6+ months, and we actually have seen a number of them trade down quite meaningfully. That doesn't mean they're dead. They aren't. They are actually massive companies that will continue to print massive amounts of earnings. But the market has really fully priced them in many ways. And this is the reason why we're starting to see a broadening of this theme beyond just the Mag 7. And we think that will continue. So we wouldn't necessarily be outright underweight the Mag 7, but we would be looking to diversify through a broader exposure for AI. And that includes other sectors beyond technology. Things like in the healthcare space, such as in the industrial space is another one. Very data-intensive industries that can use AI to simplify and provide more efficiency gains. The financial sector comes to mind. So there's a lot of ways to play AI beyond just the pure Mag 7s and the big tech names.
Now, it seems like this has been the year that people are now starting to implement. What if that implementation doesn't deliver the returns that people were expecting with AI, that they were hoping it would bring? What happens then?
That's the big concern of the market. And that's when you see the market AI names sell off, it usually has to do with the massive amount of cost that's going into this and whether the payoff will be big enough. And this goes back to the theme that we said earlier about not everyone can win here. And the market is really starting to sniff out the winners and losers. And you have seen names that have spent a lot and it's starting to really eat into the firm's earnings and cash flow dynamics, being penalized quite a lot. But you're seeing other names who have a much more balanced approach to their capital deployment and their earnings delivery continue to benefit a lot. And this is what the market is really starting to sniff out between the winners and the losers. And I think that is something to focus in on, is you need to avoid those names that are spending a lot of money and it's really starting to question their balance sheet and income statements when it comes to their quality.
And any concerns about the circular spending and investing that we're seeing?
To an extent, yes. You do have to be careful or aware of that. But at the same time, this isn't new. I mean, the reality is the tech industry and many industries are highly interconnected. And so there is a circular dynamic to spending. It might be a bit more extreme here right now, particularly with some of the providers of that capital. But at the same time, this is something that happens in a lot of industries. It's a highly interconnected world, and supply chain dynamics and the underlying relationship between companies is hugely important to success, just as it is a risk when something goes wrong. And so we're aware of it, conscious of it, but at the same time, don't buy into the massive narrative that it's a complete negative.
All right, what kind of a role do you think government's going to play in all this? I got through the either OBBB, one big beautiful bill, or tailwinds from defense, et cetera.
Yeah, this is, I think, a key area. One of the sectors that we think is a huge beneficiary from AI, and is in some cases still underestimated, is the industrial sector. And it's not just because industrials help with the AI story from an infrastructure build out, but it's also because industrials are linked to a number of other key things that are happening globally, such as the build out of energy infrastructure, partly related to AI, but the need for energy in general. Defense spending, most of that lives inside the industrial sector. We have a major war and conflict in the Middle East. Guess who benefits from the build out of additional infrastructure when it comes to rebuilding and or building new facilities for energy? It's industrials. And so there's a lot of themes that are tying into the industrial theme that will benefit that sector. AI is one of those, but there are other things driving it as well. And it's a high quality sector with reasonable valuations.
Okay, we have to take a break on that note there, Nate, but I know you're sticking around. Nate Tuft is the CIO and Senior Portfolio Manager at Manulife Investment Management, and we'll see why healthcare is on his radar. Time to see what's on the radar for Nate Tuft, CIO and Senior Portfolio Manager at Manulife Investment Management, and it's healthcare that is showing up. Nate, what are you liking about it right now?
I feel like we've talked about this one before, Roger, some time back. And unfortunately, it hasn't worked as well as we wanted it to work over the last, let's say, 6 months or so. It hasn't been an outright disappointment, but there's still a lot of negative overhang when it comes to drug pricing and just bad sentiment around this sector. But our view is there's actually quite a few positives. It's reasonably priced. It's about 20% discount to its historical average when it comes to valuations. We're seeing a pickup in earnings dynamics, and it continues to be the only sector that can compete with technology from an overall growth expectation from its secular drivers when it comes to aging and demographics. And so there are some underpinnings here that are quite positive, despite the narrative being quite negative at the top level.
Now, you mentioned, you mentioned earlier about being one of the beneficiaries of AI. How much could it help, or how much do you see it helping?
I think it's quite significant. It does depend on what part of healthcare you're talking about. As an example, AI can really improve diagnostics. And so companies that supply diagnostic tools and technology and or companies that are using those can benefit from significant efficiency gains. And more importantly, consumers can benefit from the accuracy of those diagnostics. And so you can now go into a hospital or a medical center and get screenings that are very technology driven with much higher levels of precision without invasive surgeries or other types of dynamics that require a lot more work and a lot more effort. And so that's one way. But we're also seeing it with drug companies. Drug development can be much faster, and you can do a lot more testing and hypotheticals when it comes to using AI tools to get to different drug outcomes and the precision of those drug outcomes going forward.
And is this one of those things where it's just not sexy, healthcare, compared to like tech and and what's going on there in AI and everything, and healthcare just kind of plods along?
I think that's a great point. I mean, the reality is it is a sector that's been left in the dust. It's very unloved, and people are very unaware of it. And I think the simple reality is, I've always said this, the market and market participants can only focus on so many things at once. And there's plenty of hot things over the last year, such as tech and gold, that are drawing the attention of investors. And they're ignoring this sector, even though parts of this sector has done really well. You look at biotechs as an example, it has performed very well over the last year, up 35+%. And so even within healthcare, you have had winners, but the market hasn't really appreciated that.
Do people just look and go, it just feels like they have to invest a lot of money and it takes a while to get a return on it? It just, when you see just from the research that they have to do, and then you're looking and going, well, I'm putting my money now, but I may not see anything for a couple of years, even longer.
That is part of it. I think the bigger part of it is just the regulatory risk around it. You spend all this money to develop a drug, and it may or may not work from a binary outcome perspective. And this is, I think, one of the bigger challenges, particularly for the pharmaceutical and biotech area within healthcare, is it's not just the cost to do it, but it's the simple risk that it may not work. And it may not get approved, and or their approval timeline will be a lot longer than they want it to be to get the outcome. And so I think it's the regulatory risk that's the bigger issue versus the cost of spending. And as I said earlier, AI will help when it comes to efficiencies gained when it comes to drug development.
So do you think this might be one of them? Then we might just see a landslide. Suddenly people, it's that one person sees it and goes, hey, wait a minute, we forgot about healthcare. And then it'll take off again?
We do. The reality is sectors and industries go through long-term cycles. And we have seen cycles. You go back to the Obamacare years as an example, where healthcare was a dominant outperformer for a very long time. Well, more recently, it's been a dominant underperformer for a long time. And I do think we are setting up for a period of time where healthcare can be an outperformer for the market. Keep in mind, the healthcare sector is also viewed as a higher quality sector and a more defensive sector. So if we're living in a world with a lot of geopolitical risk, people will start looking for things that work when you have geopolitical risk.
All right, we'll wrap it up on that note there, Nate, but stick around. We got lots ahead, including the Artemis 2 mission. It's set to launch this evening now. We'll talk to the Canadian company working with NASA to make it happen. And our phone lines will open soon for our first call segment. You can reach us at 1-855-326-6266. Send us an email as well, firstcall@bellmedia.ca. Go Easy logged a loss in the fourth quarter that was deeper than expected after the subprime lender surprised investors with a surge of bad debts in its vehicle financing business just weeks ago. The Ontario-based firm says it expects loan write-offs to remain elevated for a while before getting better later in the year. The company says Go Easy's long-term opportunity remains unchanged, but did not provide any earnings guidance. A new report citing several trade irritants between Canada and the U.S. includes provincial rules around alcohol and the federal government's Buy Canadian policy. The annual document, prepared by the Office of the United States Trade Representative, also mentions delays with aircraft validation in Canada and high tariffs on U.S. dairy products. The U.S., Canada, and Mexico will choose whether or not to renew CUSMA in July. Fourth quarter profit for Group Dynamite more than doubled compared with a year earlier. Revenue rose by 45% on increased in-store demand and strong online sales. The Quebec-based company also expanded its Garage brand in the UK in early 2026. The retailer posted a strong outlook for revenue growth for the full year, but cautioned for multiple risks, including tariffs, a decrease in customers, and failing to open new planned stores. Looking at the markets, they're dropping a little bit. They're still in the green, but they're up over a percentage point, and now you can see they're all well below it now. Dow by right now it's up by 0.6, Nasdaq just under a point, and the S&P 500 about 0.7. Well, NASA is expected to launch a new rocket to the moon today. It's called Artemis 2. Canadian astronaut, Jeremy Hansen will join the crew and become the first Canadian to leave the Earth's orbit and venture into deep space. A Canadian space company will also be a part of the historic moment. And joining us now, live from Florida, where the launch will take place later today, is Mike Greenlee, CEO of MDA Space. Mike, thank you very much for joining us. An exciting day for you.
It's an historic day. It's definitely exciting. We're just getting organized down here in Florida today to head out to the viewing areas for the day for the launch attempt this evening at around 6:24.
What makes this a historic day for you then?
It's a historic day. It's the first time that humans have been back towards the moon in over 50 years. The first time that a Canadian has ever gone to the other side of the moon. And this group of four astronauts it'll be the furthest that humans have ever traveled from the Earth. And so the historical aspects of the moment. And it's the opening of a new phase, a new phase of opening up a new economy. So for the Canadian space industry, which we're a key member of, the opening up of the return to the moon, the establishment of living and working on the moon, which Artemis program is constructed to achieve over the next several years. This is the first very important step in doing all of that, with this group going out around the moon today. And then the next group in 2028, there'll be 2 landings on the moon, with humans starting to set up living and working there.
All right, I want to bring Nate into the conversation. Nate.
Mike, this is a great day, exciting day for you and everyone involved. What for Artemis in general? Obviously, one of the big goals is to return to the moon. But what are some of the other main goals of Artemis over the coming years?
For sure. Well, the primary singular sentence is to live and to work on the moon, for sure. That causes us to sort out as a space community all sorts of different issues, determining how to have the reusable rocket systems that can go back and forth to the lunar surface, to be able to put communication systems on the moon, which MDA Space will be a part of, or is currently a part of, to be able to put rovers on the moon, to be able to drive around once you're there and move logistics and cargo, to be able to build habitats, to be able to look at the ability to have sustainable food sources on another planet, and then to start to explore that planet in terms of looking at what types of resources can be available to be able to do things like create fuel, to be able to then have bases from the moon, to be able to move on to further out into the planetary system. So a whole series of technology achievements will be part of the Artemis missions. In addition to a lot of human science achievements, we've studied the performance of humans in space for the last 25 years on the International Space Station. Now, obviously, putting all of that to work to be able to continue to study and advance having humans live and work on another planet with different characteristics, as we now figure out how to live and work on the moon.
And for MDA itself, Canadarm3 is a big thing for you. NASA may not be using that now. Where do you see yourself fitting in with Artemis and with the space programs in general?
Yeah, for the Canadarm3 program is Canada's program to contribute space robotics to the Artemis program. Canada, of course, through the Canadarm history, is the world leader in space robotics with the most experience of any nation in this regard. And so, right now we're in review to look at, can we take the robotics that has been targeted and been developed for the lunar area, previously targeted at Gateway, the space station that was to orbit the moon, which has now been paused to focus on getting onto the lunar surface, and then target the final design of those robotics at the uses on the lunar surface. There'll be a number of robotic needs on the lunar surface to be able to unload, manage cargo, do daily tasks. And so, we're looking at that at the moment. So as a company, we would expect to continue to be involved in robotics on the lunar surface, where we have a very strong rover capability. MDA Space has had technology on rovers on Mars for the last 15 years. We've been involved in the design of a new rover system with the European Space Agency and various teams for Mars called ExoMars, which is planned to go up in the future. And we're involved in a couple of different lunar rover programs to put rover systems onto Mars. And so for sure those items, and then we're involved in a range of other conversations where our technologies will be applicable.
Nate, I just wanted to ask one quick follow-up question. What's it like to try and adapt something that you had for going around the moon? Now you got to look at it for maybe being on the moon. How easy or difficult is it to do that?
A lot of things are the same, like the command and control and communication systems, figuring out how to have robotics control instead of 400 kilometers up at the International Space Station, now doing that 400,000 kilometers out at the moon. All of that is the same. Those robotic systems have been built for that and designed for that environment, in addition to dealing with things like lunar dust, for example. And so a lot of the characteristics are the same. The biggest change from going to a space station down to the surface would be the impacts of gravity. gravity because now you have a gravitational field that's there. So you'd have to have, you'd probably change your, your joint strength, for example, in addition to maybe your segment lengths of your robotic system for different tasks and different purposes. So definitely an achievable adaptation for Canada to consider to be able to continue to contribute robotics to the lunar surface.
All right, Dan, we'll give you last question.
Mike, you previously mentioned traveling beyond the moon, and I think a lot of our watchers would love to know, what does this mean for Mars and the likelihood of humans being on Mars in some time in our lifetime?
All of these activities on the lunar surface is definitely in preparation to be able to go further and to be able to live and work on Mars someday. So with the moon being a much closer planetary planet to work on, then that allows us to be able to work out all the issues around sustained rocket highways back and forth to the moon, to be able to move people and logistics back and forth to a habitat there, to be able to work through all the issues around habitats, living and working, food, everything I mentioned earlier. So the lunar program is important for the moon itself, but it's also important to sort out all of those issues so that we can go even further away to Mars in future years.
All right, Mike, we have to wrap it up there, and I know you want to get there early and get a good seat, so we'll let you go. But thanks very much for joining us today. We appreciate it.
Thank you. Big day for Canada. Thanks a lot.
All right, Mike Greenlee, the CEO of MDA Space. Still ahead, today's market driver is with Bloomberg's Divya Balji, and our phone lines are open. Nate Tuff, CIO and Senior Portfolio Manager at Manulife Investment Management. He's taking your sector's questions. You can reach us at 1-855-326-6266. Email firstcall@bellmedia.ca. For a look at some of the early market movers, we're joined now by Bloomberg's Divya Balji, Managing Editor for Breaking News in the Americas. Divya, thanks as always for joining us. Nike, running the wrong way, aren't they?
They certainly are, or they are taking a very, very slow walk, I guess is what we can say at this point. They reported a pretty brutal forecast outlook for their revenue and for their earnings in general. That has led to a huge decline in its shares post-market yesterday and in pre-market trading. Today, the CEO has been quite candid in talking about its turnaround plans. They're already 18 months into that plan, but the company is now saying that they are going to need a lot more time, that they are expecting to see a decline in revenues for the rest of the year as well. I mean, this is a company that has been struggling quite a bit. EMEA and China sales have been under pressure for quite some time, and that is still expected to continue, according to analysts. We have seen at least 3 big research firms downgrade the stock after earnings. I think it was Goldman, JP Morgan, and Bank of America. We've also seen a lot of share price target cuts come through as well. Now, if you think about the fact that it has been dealing with a turnaround, on top of that, the current macroeconomic environment that we're in with higher prices and perhaps people spending less, what is going to happen with Nike? How much longer is this turnaround going to take? I think those are the types of questions that are on investor minds. Analysts have been quite cautious. They don't quite want to say it's over for Nike, and they do want to see if this turnaround can actually work. Now, I guess the question is, what other trick can they pull out of their hat? There's also the World Cup. Nike does have a lot of sales that tend to come out of the World Cup as well, so that might be a bit of a push for them, but it's not a long and sustained push. It is just for one season. So a lot of work Nike has to do in the upcoming quarters to regain that confidence and that trust with investors. Incredible. Even iconic brands can struggle. Okay, RH struggling as well. People not wanting to stop and sit down and smell the roses. That was a really obscure segue into that one. I'm sorry, I stretched with that one. It's an upscale furniture retailer. Are people going to be spending money, thousands and thousands of dollars on a bed frame or on a coffee table? I'm not sure if this is the time where a bulk of people would be willing to do that, considering where else they have to put their money, say at the gas pump, where they will need it for their cars to be able to drive around. So I think this is what's a bit of a focus for RH. They have pointed to a weaker forecast for the next quarter. They are pointing to supply chain disruptions. A lot of analysts have also come out and cut their share price target. It is somewhat similar to this theme, perhaps, that we've seen with Nike. Where are people going to spend their money? And are they going to spend it on the things that they need, or will they still continue to spend it on the things that they want? And perhaps RH falls into that want category. Now, I will also say, Roger, this is the end of this last earnings season that we've had, but I do think that this theme of lower consumer demand, higher prices, supply chain disruptions, we are going to see that as we go into the new earnings cycle, which, believe it or not, starts next week.
Holy cow, I just was on their website. They have a lovely lounge set. The lounge chair is on sale for $2,500 Canadian.
$2,500. I will not be spending that on a lounge chair right now.
We could split it. Well, 6 months for you, 6 months for me. I get the summer months. Okay, Divya, thanks as always for joining us.
Thank you.
Bloomberg's Divya Belgi. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including Walt Disney. All right, let's take a look at some of the notable analyst calls and recommendations. Walt Disney is up in the pre-market as Raymond James upgrades to outperform from market perform, citing an attractive entry point for the stock. It's up about a percentage point right now. And of course, Nike, as we were just talking about, falling in pre-market trading, and the Bank of America Global Research cutting the recommendation on Nike to neutral from buy after a very gloomy outlook. PT set to $55, implying a 4.1% increase from last price. And Apellis Pharma has been cut at Raymond James, JP Morgan, Cantor, Stifel, and Citi after news that Biogen has agreed to buy it for $5.6 billion in cash to expand its portfolio of rare disease medicines. For more, let's bring in Nate Tuft, CIO and Senior Portfolio Manager at Manulife Investment Management. And I just want to talk about the first two, Nike and the sectors they're in, Nike and Walt Disney. One going one way, one going the other. Does that give you an idea of what the economy is doing, or is it just one more twist in this saga this year?
It tells me that consumers are a finicky bunch. Consumers like what they like, and any company that's tied to consumer preferences and consumer spending is in a tough spot right now, particularly given inflationary pressures and where consumers want to spend their money. I think the bigger challenge, though, is at a company level, you have someone like a Nike who's been a dominant brand for a long time. There's no shortage of competitors, and their margins are getting pressured, and they're trying to go more direct to consumer. So their business has to evolve, and they've had some struggles in doing it. And then the likes of a Disney, it's a lot of companies that roll up into Disney. And there's some of them that are doing very well, that are very strong cash flow type of drivers, such as their parks. But they've had disappointments when it comes to their TV and comes to some of their movie developments. And so it's a high-cost business to stay on top when it comes to making sure consumers are happy.
Having a little technical difficulty there, Nate. We'll get you figured out, and we'll have you back up in just a second, of course. But right now, we're talking about the World Cup fast approaching, and here in Canada, the fraudsters are already approaching. They're already here with that heavy demand for World Cup tickets. CTV's Adrian Gobriel shares a cautionary tale and tips to avoid getting scammed.
David steps up and finishes coolly.
The authenticity of Canada's men's soccer team is well documented, yet the lead up to co-hosting the World Cup is now fraught with fraud.
Fraudsters try to capitalize on vulnerabilities. They know that so many Canadians and people outside of Canada want to attend these events.
The Canadian Anti-Fraud Centre confirms they're now working with the RCMP, Vancouver, and Toronto police ahead of this June's World Cup as they work to weed out bad actors across the country and beyond.
I was embarrassed to even tell my wife, and I was actually embarrassed to do this interview, to be fair, because I'm in my 40s, man.
Adonis Ibrahim runs a rec soccer league in Windsor, Ontario. Like many, he's desperate to get his hands on a World Cup ticket. He ended up on Facebook Marketplace, where he shared that he was looking for a single ticket to Canada's opener in Toronto. Someone, apparently named Ava Green, sent Ibrahim this message. They agreed on a price of $400, half of which he paid up front. The tickets never arrived.
I was taken advantage of, and I'm doing this because I don't want it to happen to anyone else.
Fans are also being duped into paying for World Cup rental properties that don't exist. Counterfeit merchandise is also on the rise. The Canadian Anti-Fraud Centre is advising individuals to only use FIFA's verified exchange platform for resale tickets. Avoid third-party sites selling tickets and merchandise. For short-term rentals, be cautious if the price appears too good to be true. Use a credit card with fraud protection whenever possible when making a purchase.
Don't get scammed. It's not a good feeling.
With Team Canada preparing to take on the world, Ibrahim has been left still searching for a single ticket to fulfill a lifelong dream.
There are still some more affordable, legitimate tickets available for the two upcoming friendlies in Edmonton and Montreal before Team Canada officially kicks off its World Cup right here at BMO Field on June 12th. Adrian Gobriel, CTV News, Toronto.
When we come back, Nate Tuff, CIO and Senior Portfolio Manager at Manulife Investment Management, takes your questions on First Call. Time for First Call and first email, and it's from Liz. Good morning, Nate. Copper is often called the new oil of the energy transition. How tight is the current supply picture, and what does that mean for prices over the next year?
I think it's a great question. I mean, the reality is copper is a huge input to the build out of infrastructure, some of it related to AI, but some of it also related to just broader energy needs. And it's important. And we are very positive on copper. Yes, it's had a little bit of a setback here with broader metals in general, but we believe copper should trade well above 600 and probably goes to more like 650. And our price targets are in that range over the course of the next 12 months, driven by the fact that supply is constrained. It's very difficult to bring more on. And demand seems quite unrelenting, particularly given the pickup that we're seeing in some of the emerging market economies.
And I'm going to ask for myself, when you say 600, you mean, is that $6 or?
Well, it depends on how you price it, but yes, it would be basically 6.5 on this particular chart.
Because it was up above it for a while, and it's really pulled back, relatively speaking, it's really pulled back over the last month, actually, essentially, hasn't it?
It has, but we've seen this across a lot of metals who did very well. We saw some profit taking in general, and people took some chips off the table. And given the liquidity crunch that we saw with the crisis in Iran, people did pull back on some of this trading, and as well as some risk around growth in general. But we think this will ultimately pass, and the demand is still very strong for this particular commodity.
All right, I want to get an email in from Catherine now. It says, Nate, should I be concerned about the software sell-off? I think everybody's asking that question.
We should be concerned to an extent, but let's be clear here. Software is not dead. And I think there's this very large view that somehow AI is going to have a mass extinction event for all software companies. And that's absolutely a false narrative. But it does have some worries for some software companies. So if you own the data and you are built into the enterprise systems of these companies, it's very difficult to replace you. And so software companies that own their data and or built into the ecosystem of companies, the enterprise type of software, is actually probably a good opportunity to pick up some of those shares right now because they're going to adopt AI. They're not going to let AI companies destroy them. They're going to adopt them. They own the data and they're already built into company ecosystems, and it's very, very difficult to displace them.
All right, Nate, we're going to stop for a second. We have some breaking news that we want to get to. U.S. President Trump says Iran has asked for a ceasefire, which he says he will consider when the Strait of Hormuz is open, free, and clear. This according to a post on Truth Social. It follows up with, until then, we are blasting Iran into oblivion. Can I bring you back in? I'm sorry. I don't mean to laugh at that, but this is the leader of the free world. How do you think the markets are going to respond to that?
I think the markets are accustomed to those types of news and delivered via tweets. And so at this stage, the market is expecting to see a lot of back and forth on this subject matter. And they do kind of look through it. I mean, they might have a short-term reaction, but at the end of the day, the market is clearly looking for a positive outcome here. And I think at this stage, they're still positively intended when it comes to what they're hearing from the Trump administration. And so time will tell, but this is not uncommon approach to how news is delivered from the Trump administration.
All right, we will have more on this throughout the day, but for now, we're going to get back to our emails. And this one is from David. It says, how should investors think about duration risk in this environment, especially with markets still uncertain about the path of inflation and fiscal spending?
Yeah, this is a question dear to my heart because it is a big challenge for anyone that's thinking about asset allocation in multi-asset portfolios, which is a key part of what I do every day. Fixed income is still a useful tool in portfolios, no doubt about it. But we are underweight duration, and we do think the efficacy of fixed income, particularly as you go further out the yield curve, is becoming increasingly more challenging as a diversifier in portfolios. And so when we think about using it, we are thinking about using it in a more diversified way beyond just fixed income to get that diversification. Commodities as an example, other types of liquid alternatives, certain types of private assets. So relying on duration as your only safe haven in a portfolio, I think is a challenge. And we should be thinking about keeping shorter in our duration. And we should be thinking about other diversifiers, not outright eliminating it, but just thinking more thoughtfully about how we get good diversification into portfolio construction.
It sounds like balance is everything.
Balance is everything. And balance is more than just stocks and bonds in our view.
All right. And I was just looking at the rest of that post from Donald Trump. Along with blasting Iran back into oblivion, they say, or as they say, back to the Stone Ages, not Stone Age, Stone Ages. So just another day in Trump world. We'll have to wait and see how the markets react and how everything else reacts. Nate, thanks as always for joining us today here on The Street. We appreciate it.
Thanks for having me.
All right. That was Nate Tuft, CIO and Senior Portfolio Manager at Manulife Investment Management. He was with us today. Andrew Bell's up next with the Open, and trading gets underway about 30 minutes from now. Have a great day.